Saving is not investing, and getting this wrong is losing you money. Watch the video to find out why they are different and when you should be investing versus when you should be saving. Hi there, welcome to my channel. Let's talk money and how to get more of it. Women are known as being excellent savers when they get around to it, and men are known as the investors. And unfortunately, this is being held up as true in the statistics. In the UK alone, we have an investment vehicle called the ISA, which is a tax-friendly vehicle. Women and men each hold equal amounts of these investing vehicles called ISAs. However, men are more likely to put stocks and shares into their ISA and women cash. Now, while saving and having easy access to an emergency fund is sensible, that's not the way to grow your wealth. That is what investing is for. And both concepts are an extremely important part of your financial plan, but for very different reasons. So let's take a look at what saving and investing are and where they are appropriate in that financial plan. What is saving? Saving is regularly depositing money into an easily accessible bank or building society account. Easily accessible means you have instant access and can draw it out when needed. Now this brings into the spotlight a little element of discipline, because saving means that you're going to have some element of discipline to build up a reasonable savings balance, in that you don't get sidelined and end up spending on those shiny sparkling things that are forever being flashed in front of us. Money in a bank account is also relatively safe, as you are unlikely to lose actual capital value. This means you will get back exactly what you have saved, plus a small amount of interest. In addition, deposits into authorized banks and building society and credit unions in the United Kingdom are guaranteed by the Financial Services Conduct Authority by up to $85,000 for a single bank account, or $170,000 for a bank account held by a joint couple. The disadvantage, though, of cash deposits is that you're unlikely to be earning more than inflation. And this means £100 today can buy a certain basket of goods, but it's very unlikely that that same £100 in a year's time will be able to buy that same basket of goods. What is investing? Investing is using your money to buy an asset that you hope will either provide a steady income or will grow in value, or in most cases will do both. Investing exposes your money to volatility. And volatility means the value of the asset you bought will go up and down. If you've bought a risky asset, the value may go down permanently and you may lose your investment. Volatility, though, does not in itself cause actual losses, but it does cause something called paper losses. And let me explain that a little bit further. You buy a property at a certain price, and shortly thereafter the economy goes through a rough patch and the value of your property goes down below the price you paid. You have suffered a paper loss, and the paper loss is the difference between the price you paid for your house and the current value of your house. However, you will only suffer an actual loss if you sell your house at that depressed value. If your house were to burn down, however, and you did not have insurance, you would suffer an actual loss. But you can mitigate this risk by taking out insurance. And just as you can mitigate the risk of your property asset, you can mitigate all the other assets you invest in by taking simple risk mitigating techniques that we'll discuss a bit later. But first, let's take a look at the more common type of investments. And the first one are shares. These are sometimes referred to as stock or equities, and they represent an ownership of a company. Now, even if you hold a tiny little share in that company, you are an owner. And you will either lose if that company goes bankrupt and does badly, Or you can gain if that company does exceptionally well, and you can gain directly through a company deciding to pay you dividends, or through the value of your investment increasing as the value of that company increases as it does well. Now, shares may be listed on a stock exchange, which means the general public can buy and sell these shares easily, or they may be privately held, and this means they're a little bit harder to buy these shares and, of course, as a result, harder to sell. Bonds, the second asset class, are a debt security, and they're something like an IOU. But a bond is an IOU that can be traded if it's listed on the stock exchange. In some cases, however, they are privately placed. And by investing in a bond, you have lent money to the issuer for a given period of time and a given rate of return. The issuer can be a corporate or it can be a government. But in either case, the issuer is obligated to pay you back the amount they lent them and to pay you the interest rate that they offered you for that given period of time. And this obligation makes bonds considered a little less risky than shares, because the company has no obligation to pay anything to the shareholders or the owners. In addition, this obligation means that if the company goes bankrupt, the bonds will rank ahead of the shares in the priority of payments. So the company goes bankrupt, the assets are sold to pay all the creditors, bonds get paid from the sold assets, and the shareholders sit at the bottom and probably get nothing. The third asset class is property. And you can either own property directly, or you can own it in an investment trust or a real estate investment trust called a REIT. Property that you own and live in is not usually considered an asset because it doesn't really provide you with a regular stream of income. In fact, it's probably more like a liability because you have to pay back your mortgage, you have to pay maintenance on the property and such. However, if you were to rent out a room in your property or just rent out a whole property, that is called an investment. The next investment class is commodities, and this would be like oil and gas and gold. And we can invest directly in gold, but we can't invest directly in the other commodities such as oil, except through the futures and options market. And typically how investors like you and I get exposure to commodities is through exchange traded funds, which give us exposure across a number of different companies in the commodity sector. The asset class that we look at next is cryptocurrency or Bitcoin. And this is a very volatile asset class currently. And so to mitigate this risk, you'd probably want to include just a little bit less of this type of asset class in your portfolio. And the last, less obvious asset class we're going to consider is cash. And this is a very important part of your portfolio as it gives you the flexibility to participate in investable assets if they become available cheaply on the market. So let's say the market crashes. This is exactly like an end of season sale, and you would want to have the cash on hand to go and take advantage of the cheap assets that you can buy. So investing is not a guarantee, and it carries a high degree of risk in that you may lose your capital invested. But that doesn't mean, as we mentioned earlier, that there are not ways of mitigating this risk. And the most obvious way is through diversification. And this means diversifying your investments, i.e. not putting all your money into one specific investment, such as one company, into one specific asset class. For example, investing only in shares, or even more specifically, one industry, such as having all your money in tech stock. Further on, you could say even geography exposure. In other words, you don't want everything in the UK with the potential Brexit exposure that comes in 2020. So diversification has been simplified for us as investors because you would think for diversification you need a whole lot of money to go and buy all these different classes of assets. But we currently have what is known as mutual funds, unit trusts, exchange traded funds, which provide a ready-made diversified portfolio. There's even another step in these funds that provide an additional level of mitigation to risk, and that is some of these funds are considered passive funds. And passive means that the selection of assets in the fund is simply driven by a computer, and it only invests in a specific given index. In other words, it will buy the S&P 500 shares, and that's all it can do, no human thinking. An active fund, on the other hand, invites human expertise to try and find the best classes of assets, and as a result brings a little higher element of risk that potentially that human doesn't make the best choices of the assets. But in either event, whether you do a passive fund or an active fund, you get a ready-made diversified portfolio easily, and you are able to mitigate your risk with a small amount of money. Where do saving and investing fit into your financial plan? Saving serves two functions. Firstly, before getting started investing, you want to have the financial foundations in place to support you. And a critical element in these foundations is your emergency fund. Things happen in life. Those emergency repairs, a medical issue, redundancies, divorce, to name but a few. And you don't want to have to sell your investments to access cash at a point in time when the market may be down because of an emergency. And so your emergency fund serves as a cushion for these events. Your emergency fund should cover your basic monthly living expenses, your mortgage, your utilities, your food, and anything else you consider a necessity as opposed to a want. And it should be sufficient to carry these expenses for a number of months. And these will be a number of months that make you feel comfortable you can deal with an emergency. But at a minimum, your emergency fund should be sized at about 3 to 6 months of these basic expenses. Secondly, the investment markets are volatile. And for a period of less than 5 years, your investment may be very vulnerable to this volatility. As a result, goals that you want to have met in the next 5 years or less are more suitably provided by saving up a lump sum. You don't want a dislocation in the market to mean that your plans are derailed at a specific point in time. And this would typically be for your goals that are for a wedding in less than 5 years, for a house deposit, for that dream holiday, whatever these short-term, less than 5 year goals are, they're much better met through a stable, liquid investment such as a savings account. Looking at investing. Investing is your wealth builder. Once you have your foundations in place, which include amongst other things, understanding your risk tolerance and knowing what your time horizon is, it's time to get your money working for you. Knowing your risk tolerance means that you're able to select a well-diversified portfolio that will produce a return that's consistent with your risk. So in other words, you don't want a huge outsized large return, but you're taking so much risk that you can't sleep at night. Also, when you invest, you want a long-term time horizon greater than 5 years, so you can take advantage of upwards trajectory in the market over time. So in other words, although you're experiencing volatility on a day-to-day basis, in general, historically, the markets have consistently moved upwards with that volatility. In addition, while you have that long-term view, if you reinvest the income you are earning on your assets, in other words, you're accumulating it, you will earn gains on that income as well. And that's called compounding. In other words, earning a return on a return. So for example, if you had 1,000 or 10, let's say 10,000 to invest, and you're earning a nice 10%, it would literally take you 7.2 years to double your money because of compounding. And that is the magic of investing. So imagine investing as pushing the snowball up the mountain. It's a little bit hard because you've got to build it up, but as it's pushing, it's accumulating snow. And you get to the top of the mountain, and then the snowball is off running by itself, accumulating. And you've created a self-sustaining nest egg that produces an income that can support you without you having to do anything for that income. And that is your money working for you. So investing enables you to build that big nest egg to support you in future life, and saving enables you to create the foundations to create that life and to meet those short-term goals. Saving and investing are different concepts with a very important common goal, and that is to create your financial freedom and your choices in your life. If you're still a little bit confused about when to save or invest, grab the saving and investing pamphlet below that will give some indications of when each are applicable. If you like this video, please let me know by liking it, share it with any other ladies who want to change their financial story, and comment below if you found anything useful. For financial education and money talk designed for women, please subscribe to my channel, hit the bell to be notified when I post a new video as well. It's been lovely chatting to you, and I so hope we get to speak in the future again.